it's Rav. Welcome to the Everyday Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. We all want more time in our life. But what we do is we take this precious 168 hours, if we're not sleeping, we're working. We're taking our time to go to work to make money in order to live. We take our time, we go to work, we need to make money in order to provide. And that's a good thing, and we should always be doing that. But imagine a life where money could make you money, so you could work a little less and you had more time for the things that matter most. Family, friends, engaging in a purpose greater than yourself. That's what Everyday Investor TV show is all about. I'm very excited about this show. My good friend Jas is on the show, and he's going to be talking about how we can make money investing in pre-construction condos. You don't want to go anywhere. Everyday Investor continues in a moment. Hey, it's Rav. Welcome back to Everyday Investor. Today I'm talking to my good friend Jas, and he's going to be teaching us how we can make some money, grow our money investing in pre-construction condos. We're going to go through the 4 questions that we always go through, because whenever you're faced with any type of investment opportunity, you always want to ask 4 questions to start. Number 1, what is the return on investment? 2, when do I get that return along with the money that I put in? 3, what is the minimum investment amount needed? And 4, you look them right into their pretty eyes and you ask them, what is the risk, the worst case scenario? If they can't tell you, run real fast. Super excited to have my friend Jas here. Jazzy, what's happening, my friend?
How you doing, Rav? Thanks so much for having me, my man. I'm very, very excited. I hope when you mentioned the pretty eyes, you were talking about mine.
Listen, don't be so modest. I am so grateful that you gave me time to be able to have you, and just, you know, these shows go by really quick. There's only 22 minutes in this in an episode, and so I want to get down to business. But if for you that are watching, if you want to learn about Jas Takhar and hear his mind and his heart and helping people, you can just punch in his name and he will be all over the place and nurturing, and he always does with me. Jas, we're talking about one of the many things that you do, but one of your favorites, and that is investing in pre-construction condos. We always try to make the Everyday Investor high school senior friendly, if you will. Can you talk about that concept? What does that mean? Investing in a pre-construction condo. Just kind of give me a little bit of theory, philosophy around that.
So, as an investor, Rav, you're going to be investing into a condo that is not yet built, and so you're buying at today's value for something that's going to be built generally about 3 to 3.5 years from now. What that allows you to do, and why I think it's so common and so many people like this type of investment, it's for a few reasons, but the main ones is A, you get to buy some time in terms of your 20% down payment. As we all know, for everyone who's watching and listening right now, as an investor, you got to put down 20. And so you're able to do that in installments. So it's like 5% in 30 days, 5% in 6 months, 5% a year to a year and a half, and then 5% generally at occupancy when the building gets built. You also don't need to get finance. Like you can't, there's no mortgage to get because the building's not built yet. There's a formality, which is where you need a pre-approval, and we get that kind of handled for you. It's a very turnkey process in that sense, but you don't actually have to tie up any leverage, like you don't have to go get a mortgage until the building is actually built. And it's why a lot of the younger generation is investing into pre-construction, because it's a forced savings plan, right? You don't have to come up with that 20% down all at once. Once you move forward with a condo, with a unit, then you have to put those installments down. And so you don't go buy what I like to call silly stuff, like things that don't make you money. And so you have to put down that 20% in installments. And so that always makes it very, very beneficial for investors.
Well, listen, you had me at hello, because the first thing you said, and really park on that for a second, is I am buying something at today's price, but not receiving it until On average, what? 3 years, 4 years? What is it?
I would say 3.5 years to be exact.
3.5 years on average. And so by then, if I buy right, generally speaking, I've already made money when I acquire it because prices go up and down upwards, as you always teach me, like a yo-yo on a escalator. But Jas, so then therefore location matters.
Well, number one thing that I'm looking for is location. Can't pick up the building and move it. And if you look at world real estate, values appreciate the most in and around transit. In fact, Harvard did a study not too long ago. If when looking at real estate from an investor's perspective, if you can buy in a building that's less than 300 meters away, you're going to see the highest in appreciation. But you're also going to see the best when it comes to rentability. That's what tenants want to be. They want to be able to jump on a subway, jump on an LRT, whatever it is, something that's very close to them, less than 300 meters. So location, there's a reason the old adage is location, 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 but then you also want to look at the builder. You want to make sure that the builder, it's not the first time at the rodeo, because I don't want to be used as a guinea pig in this, and neither do you and nobody else who's watching. And then there's certain incentives that we need to know that are in place for an investor.
And so location matters. You said one of the biggest things that you look at is transit. So if it's close to transit, that's where people want to be, obviously, because a lot of people that are living in condos don't necessarily have cars, so on and so forth. On that point, as an investor, I'm renting it out, let's say in Metropolis, downtown Toronto. There's lots of people that don't have cars. Do I still want to purchase a parking lot with that?
If like, look here, if you're downtown Toronto,
parking spot rather?
Yeah, a parking spot right now would go for, in downtown Toronto, about $85,000. It comes down to supply and demand. And so to answer your question, if you're okay with the 20% down on that $85,000, okay, so you're looking at about $17,000 there. If that's not going to make or break you having the ability to invest into the condo, then I would say yes, buy the parking spot, because it's just basic supply and demand. We don't have a lot of parking spots in a certain building. In fact, it's close to about 30% of the building units will have parking available to them. And so, however, it's not needed. Why? Because the age group that's renting these units, man, like, and Rav, when you and I were 16, we probably slept at the DMV, right? I mean, nowadays, you don't have that younger generation having cars. They're okay walking, transit, taking a subway to work, or just taking in a bike. So you don't have to have a parking spot, but if you're okay with that extra 20% down on that 85,000 on average, then I would say yes, go for a parking spot.
Okay, and then transit matters. What about the economy? What about what they call gross domestic product, the GDP, people moving into that city? How important is that?
Well, look, I mean, again, as I said, supply and demand, immigration, for me in the GTA, I mean, we're looking at 200,000 people coming into the GTA year after year for the next 10 years. So that tells me we're going to have 2 million people. And for anyone who lives in the GTA, we know, but if you don't and you're outside the province, we're kind of like on a real estate island here. The south of us, we have the lake. We haven't figured out what Dubai has yet and been got the ability to build on water. And then north of us, we have what we call the Greenbelt legislation, which preserves some of the land. And so people come to the GTA all the time and say, you guys have so much land. I know, but it's restricted. We can't build on it. And so that's why you see a lot of cranes in the sky. In fact, the only city in the world that's outpacing Toronto right now is Singapore when it comes to cranes, the amount of condos that's being built. So immigration plays a massive role in terms of when is a good time to buy.
And when we see all those cranes, one of the things that you teach is you may think that we're going to be oversaturated, but that's not the fact. The fact is we only see cranes once a builder, a developer only puts up the crane once the product is like 70, 80% sold. Is that correct?
the bang on. It used to be 70, it's now to 75. Now it's 80%, which I love. Like, I know some of the builders don't like it because they want to get to construction sooner. Some of the investors are like, well, I want the building to be built quicker. However, it protects us. You know, as Canadians, we're very conservative. I think it's one of the main reasons why we were able to get out of that 2008, 2009 recession a lot quicker than the rest of the world. In fact, the rest of the world looked at Canada and the GTA and said, how did you guys protect yourselves? Well, the banking system is very conservative. Just because you can walk, talk, and chew gum at the same time doesn't mean you can get a mortgage here. And so I like the fact that the building has to be sold. It's at 80% now. That's the only time that the builder gets their construction financing, and that's when we see the cranes.
And Jas, just before we go to break here quickly, within a minute or so, what does the effect of COVID have on investing in pre-construction condos, if any, in your opinion?
Well, look, in my opinion, I actually love this strategy more than ever now during COVID. And the reason is because we buy time to actually find tenants. See, you're buying today, okay, and this is going to be built on average 3.5 years from now. It gives us all that time, that 3.5 years, to let the dust settle, to let the planes start going in the sky and landing. As I mentioned, immigration plays a big role. I think it's safe to say we're going to be out of this. You know, I don't want to put a time to it, but I think very soon, right? Definitely, I think before that 3.5 year mark. And then the rest of the world is going to look at Canada once again and say, wow, did you guys ever take care of your people with the CERB and just in terms of our numbers being lower than a lot of the other places, that the immigration, it's actually going to be more than 2 million in 10 years.
I love you, Jas Takhar. We're talking to my good friend Jazzy. He's teaching us how we can make money investing in pre-construction condos. We're going to get down to the numbers. Don't go anywhere. Everyday Investor comes back in just a moment. Hey, it's Rav. Welcome back to Everyday Investor. Today we're talking to my good friend Jas, and we're talking about how we can grow our money investing in pre-construction condos. He is the guru, the expert when it comes to investing in pre-construction condos. Jas, thanks for being on the show. One of the things that I was going to talk to you about is you're a huge believer in this. You don't want anyone to get in this game if they're going to buy a pre-construction condo and think that, the plan is to flip it or to assign it. Now, somebody may do that, but you should never get into this game, this investment strategy. You should always be with the intention to hold or rent out, because assigning or flipping brings too much risk. Am I correct on that?
Yeah, look, I mean, my macro thought process on investing is buying and holding. It's the way to create long-term wealth. I mean, you speak about this at nausea through this show, and I love it because we believe in the same thing. You have the incentive and you have a clause, or you've got to make sure that you have a clause in the contract that allows you to do an assignment. The street term is flipping the paper. But if you go into it with only that strategy, it's a full speculation. Like, you might be better off driving to Niagara or flying to Vegas, right? Because, bet on black or red, so to speak. Because, like, if you know that you can hold on to it and get the mortgage, you want to use that assignment clause more as a security blanket, because life could happen in that 3.5 year period. But if you hold on to this, and we're going to speak about the numbers now, if you hold on to it, the longer you hold on to it, the better the return's going to be. And so if you don't flip it, you're actually going to make a lot more money.
Okay, teach me. Go ahead. I got my marker. I've got the board here.
I love it.
And I'm wanting you to nurture myself and the viewers at home, or wherever they are, or even listening via audio. How do we make money investing in pre-construction condos? This is a live deal recently that we're looking at.
Yep,
okay.
Yep. We actually have something like, we have this available right now. It's a condo in the area of Vaughan, which is just outside of Toronto, but it's less than a 300-meter walk to the subway station. In fact, it's the only subway station outside of the city of Toronto. Okay. It's a 1-bedroom plus den. The purchase price is $563,000.
So purchase
$990. $563,990. $
563,990. That's the purchase price.
Yes.
Okay.
We got to put
So,
down, yep, we got to put down 20%.
okay, so our down payment, 20% equals?
Equals 112,798. I rounded it to 113 just to put a little bit
Sorry,
more, but to be exact, it's
112.
11798.
798. Okay, so that's where that's Rav's investment amount. How much is needed to get into this deal? It's $113,000. Whether I get that out of my left pocket, right pocket, credit line, somebody else, there's various ways, and that's a topic for another show. But this is my investment amount, about $113,000.
And it's a yes, and the neat thing here is, as I mentioned earlier, it plays out a little differently because this is going to be put down in installments. You're not going to have to put all that 113,000 all at once. It's broken into installments over a 3.5 year period.
Yeah, so about whatever it is, 26,000, 27,000 times 4. So in the first month I put down 27, then maybe 6 months later. And then the last one is not even until closing, like the 3.5 years later, correct?
Exactly.
Okay. So that's important. That's important to know, in case somebody's going to watch this later.
And because when we talk about return on your investment, I'm going to talk about the full return on the investment. And if we have some time, I'll actually show you why the returns are even higher than what we're going to go through. Because if you base it on, for example, your first installment of $27,000,
Yes.
I'm going to show you how you're going to make returns of 100% on this.
Yeah.
Right? And so, but
Yes.
we can break that down a little bit more if we have some time. But let's continue here. So you have a down payment of $113,000.
Yeah.
This is going to be rented. Okay. This is going to be rented in 2024. And this is where a lot of people make the mistake of saying, well, the numbers don't make sense. The numbers don't work out. The rent's not going to cover the expenses. It's because they're not looking at what the rents are going to be in 2024. What we do is we take today's rent and apply a very, very conservative number of 3% year-over-year increase.
Okay.
Now, for everybody who's watching in the Greater Toronto Area, for the last 2 years, we've seen 11% year-over-year increase in rent.
Say that again?
11% year-over-year increase on rent in the Greater Toronto Area.
Wow.
And so we like to be ultra conservative and say, okay, let's work off 3%. So the rent that we're going to see here is going to be approximately, for a 1-bedroom plus den in 2024, you're going to be seeing about $2,450 as rent.
2,450. Okay. And do I need to times that by 12 or we're good here?
We're good here.
Okay. So once I acquire this property, I'm going to get this rented for $2,450, and hopefully, because if I take 563 minus the 113, that's what's that? $440,000, whatever it is. That mortgage plus maintenance fees plus insurance, this is going to cover all that. I'm sure you're going to tell me.
That's going to cover not only, and you missed out the property tax, that's going to cover your property tax as well. So that covers all your expenses. Now, are you going to be seeing $500, $600 a month positive cash flow here? No, you're not. But your rental income is covering your expenses. You'll look at about $50 a month positive cash flow. But you know what? Just for argument's sake, we can say that it breaks even.
So we're going to take that $50 a month, $600 a year, and we're going to pay someone to change the light bulb if we have to change the light bulb for Susie who's renting, because we're such great landlords. We take care of our customers, clients,
and a bottle of wine, and a bottle of wine, Rav, at holiday season.
Yes, we'll buy them a bottle of wine. That's right. So cash flow, we're making no money. Okay, end of show. That's it. No one's investing in pre-construction condos. But wait, Jazzy, there might be more. Is there more?
I was going to say there's more. Just wait. Okay. Because we all know that that cash flow is only one way that you win in real estate. There's lots of other ways you win in real estate. Let's talk about that. Let's start with the passive appreciation.
Okay.
In the last 40 years, we've seen an increase in the Greater Toronto Area of 7.3%. Last 100 years, every decade, values double. But I like to use a conservative number of 5% year-over-year increase.
Okay. So
at 5% year-over-year increase, you're looking at $28,199.
28,000.
$199.
Now that is 5% of the 563 in just 1 year.
Yes.
So just in 1 year, I only have a couple pieces of paper.
Exactly.
I just have a contract, and you're saying I've made 30 grand in 1 year conservatively with a piece of paper.
That's all you, and that's where I was saying, and that first year, you would have put down, say, let's just say it was 10%, 5% in 30 days, 5% in 6 months. You would have put down 10%, would have been approximately $56,000.
Yeah.
You're now looking.
That's 10%. Okay, so if I only put $56,000 down, but I made $28,000, then I made in my first year 50%.
You made exactly 50%.
I put down $56,000 in 2020. And in 1 year, I made 28 grand. So I made 50% in 1 year with just a piece of paper.
With just a piece of paper, and what you've done is you wrote 2 checks. You wrote your 5% check for 30 days. You wrote your 5% check in, call it 6 months.
Okay.
From the date of purchase. No renting out, no dealing with tenants, no dealing with toilets, nothing of that sort.
Jazzy, I'm happy with my 50%. Or is there more?
Well, there is more. Because I've only calculated the passive appreciation that the market has given you. There's one other very, very important appreciation that takes place here, and that is active appreciation, not from the perspective of you doing any renovations to this property, but the builder forces the appreciation in the allocation process of units. They would increase the purchase price, okay, from a first access. So it's very important. We spoke about the location, the builder, and needing like an assignment clause, which is one of the incentives. But it's also very important on at what stage you buy this type of unit, or when you invest in this type of strategy. You need to buy at the absolute first stage of pricing, because the builder will also increase the pricing on average about $15,000 every time they allocate units.
So an average condominium, and Jazzy, we only have a couple minutes left. An average condominium is how many units on average? Throw it out.
I'm going to say about 300 units.
300 units. When that condominium is ready to go to sale, we're not releasing 300 units. We might be releasing 30 or 40, or tell me, how many do we release in phase 1?
You bang on. It's about 30 to 40 units.
Oh, about 10%.
10%.
So we create the demand, we release 30, that's at a lower price. Then the next phase, we release another, I don't know how many, but it's going to be at a higher price.
So every stage, so there's going to be about 3 to 4 different stages within the first year. Contrary to what a lot of people believe, Rav, that the builder wants to sell out of the building right away. No, they don't, because they want to keep on increasing pricing. That's how they get to their performance as well.
Okay, so if I get in at phase 1 in this example,
yeah,
and then somebody buys in phase, how many phases do we have in a 300 unit building?
Well, in total, you're going to have about 5 to 6 phases.
Okay,
so the first year, you're going to have 3.
Okay, so how much did I make if I buy phase 1, somebody else bought phase 3? On this example.
$45,000.
$45,000. Okay, so about 8% or so it increased.
Exactly.
45,000. Okay. And then somebody's paying down my mortgage.
Well, not yet. They're not paying down your mortgage because
Correct.
The building in the first year is not built. That's going to be that takes place when the building actually gets built.
Perfect.
in this strategy, if we only talk about the first year, Rav,
Yes,
we're
yes.
talking about the appreciation that's happening with the market as well as what's happening with the builder.
Okay, so I add these two numbers together, right? 28, 199, and 45,000. Is that right?
Yep.
Okay, and so what does that give me?
You're giving me $73,000.
73K, and I only put down 56,000.
56,000.
So what is what is 73,000 divided by 56,000? Move the decimal point twice. What do we got there?
A 76% increase.
How much?
You had a 76% return on your investment right now.
76. No, because I made 73,000.
You made 73,000.
And I'm only
only putting down 56,000. I went on the purchase price, just so you know.
Yeah, so go 73,000 divided by 56.
130% return on your investment.
Yes, my ROI. How much?
130%.
Not bad for a year's work.
Not bad, Rav. For a year's work, we see. So I've done 200 of these every single year for the last 7 to 8 years. So let's work on that. As you're looking at about 1,400 units. On average, that's what my investors are seeing. If you buy at the first absolute stage of pricing, what happens a lot is the public will walk in when the doors open on their own, and the builders already increased the price 3-4 times by that time.
Yeah.
And so you got to be very, very careful at the stage that you're buying these units at.
Jazzy, time is flying. Thank you so much for your wisdom. We'll definitely have you back like we always do. You're always welcome to be on the Everyday Investor because you nurture people and love people. And that's what I appreciate about you. Thank you so much for being on the show today.
Thank you for having me, my man.
And thank you for those that are viewing, listening. Without you, we wouldn't have a show. So grateful that you tune in every single week. Make sure you tune in next week. Same place, same time. Honey, I love you. I'll be home soon. Bye, everyone.